The wealthiest individuals do not outtrade the market. They simply outweight it. In a world obsessed with quarterly earnings and 24-hour news cycles, the average holding period for a stock has plummeted from 8 years in 1960 to less than 6 months today. This collapse in patience has created a massive structural inefficiency in the global economy known as the Time Horizon Arbitrage. By extending the window of success from months to decades, certain market participants are able to capture value that short-term traders literally cannot see. This analysis explores the mechanics of how extended timelines neutralize risk, the mathematical certainty of long-term compounding, and why the ability to ignore the present is the ultimate competitive advantage in building a multi-generational legacy. It is a fundamental shift from playing a game of speed to playing a game of endurance, where the finish line is measured in years, not ticks on a screen. Human biology is inherently poorly suited for modern wealth preservation because the brain is wired for immediate survival rather than abstract, future-dated rewards. Research in neuroeconomics suggests that the amygdala, the brain's fear center, triggers a flight response during market downturns, forcing many to sell assets at the exact moment they should be holding them. This physiological impulse is what drives the retail churn that institutional investors often capitalize on. The financial industry often exacerbates this by focusing on alpha, or the ability to beat the market index over a short period. However, the data reveals that after fees and taxes, fewer than 10% of active fund managers consistently outperform the S&P 500 over a 15-year window. The constant search for the next big trend creates a friction cost: trading fees, capital gains taxes, and the slippage of missing the market's best-performing days. Consider the impact of missing just the 10 best days in a market over a 20-year period. Historical analysis shows that an initial investment of $10,000 could see its total returns cut nearly in half simply by being out of the market during those brief windows of recovery. Short-termism isn't just a mental hurdle. It is a quantifiable drain on total capital accumulation. Most institutional frameworks are built around the quarterly capitalism model, where CEOs are incentivized to boost stock prices every 90 days to satisfy shareholders. This creates a vacuum where long-term projects, those that take 5 to 10 years to reach profitability, are often ignored or underfunded. This vacuum is where the Time Horizon Arbitrager finds their greatest opportunities, investing in the value that others are too impatient to wait for. But here's where it gets interesting. While the crowd focuses on the noise of the current week, the math suggests that the probability of success shifts dramatically as the calendar turns. The fundamental core of the Time Horizon Arbitrage is the statistical smoothing of volatility. When looking at the S&P 500 since 1926, the probability of a negative return over a one-day period is roughly 46%. However, as the time horizon expands to 1 year, that probability drops to 25%. At a 10-year horizon, the risk of a negative return falls to approximately 6%, and over a 20-year period, it has historically reached 0%. This means that risk is not a fixed attribute of an asset, but a function of time. An asset that is considered high risk over a weekend may be low risk over a decade. By simply refusing to sell during the inevitable 10% or 20% corrections that occur every few years, an investor transforms their portfolio from a speculative bet into a mathematical certainty of participating in global growth. Compounding interest is often called the eighth wonder of the world, but it requires a critical mass period to function. If a person invests $1,000 a month at a 7% annual return, it takes roughly 25 years to reach the first $750,000. However, the jump from $750,000 to $1.5 million takes only 7 more years. The arbitrage exists because most people abandon the strategy during the first 15 years when the growth feels sluggish and invisible. This is the inertia dividend. In a study of account performance by a major brokerage, it was famously discovered, though perhaps apocryphally, that the best performing accounts belonged to people who had forgotten they had accounts at all or were deceased. Their inability to react to market news was their greatest financial strength. The data tells a different story than the headlines. While the headlines focus on the crash of the day, the math focuses on the recovery of the decade. The ultra-wealthy and large-scale institutions, such as the Yale University Endowment, operate on a different plane of time. They utilize what is known as the illiquidity premium. Because they have no need for the cash in the next 6 months, they can invest in private equity, real estate, and venture capital, assets that are locked up for years. In exchange for this lack of liquidity, they have historically earned returns significantly higher than those found in the public stock markets. Family offices, which manage the wealth of centimillionaires, often use a bucket strategy to enforce this arbitrage. They keep 2 years of living expenses in cash or short-term bonds, 5 years in medium-term growth assets, and the remainder in forever assets. This structure ensures that even a 50% market crash doesn't force the sale of long-term holdings, because the immediate lifestyle is funded by the first bucket. Furthermore, the tax efficiency of long-term holding is a primary driver of wealth. Every time an asset is sold, the government may take up to 20% or more in capital gains taxes. By holding an asset for 30 years instead of trading it 30 times, an individual allows the government share of the money to continue compounding for their own benefit. It is essentially an interest-free loan from the Treasury. This approach requires a shift in identity. One must stop seeing themselves as a trader and begin seeing themselves as an owner. Owners of businesses, owners of land, and owners of intellectual property do not check the price of their holdings every morning at 9:30 a.m. But implementing this level of discipline is easier said than done without a systematic approach to capital. To successfully execute a time horizon arbitrage, an individual must build systems that automate discipline. This begins with dollar cost averaging, a process where a fixed dollar amount is invested at regular intervals regardless of price. This removes the emotional burden of trying to time the bottom and ensures that more shares are purchased when prices are low and fewer when they are high. Secondly, the use of tax-advantaged accounts like the 401k or IRA in the United States provides a legal wrapper that discourages early withdrawal through penalties. These structures are designed to enforce the time horizon arbitrage by making it expensive to be impatient. Over a 40-year career, the difference between a taxable account and a tax-deferred account can result in millions of dollars in additional wealth. The final component is information filtering. The time horizon arbitrager understands that most financial news is noise designed to generate clicks and ad revenue. By unsubscribing from daily alerts and focusing on annual reports or macroeconomic shifts, an individual preserves the mental capital required to stay the course during periods of extreme market fear. Real wealth is rarely the result of a single brilliant trade. It is the result of 1,000 boring days where nothing seemed to happen, but the underlying assets were quietly compounding. It is the mastery of boredom in pursuit of a result that most cannot even imagine. When the timeline is long enough, the volatility that terrifies the world today becomes nothing more than a footnote in a success story. The greatest leverage a person possesses is not their capital or their intelligence, but their ability to wait while everyone else is running. If this changed how you think about wealth, the next video breaks down the specific asset classes that benefit most from compounding.